Hey, good morning. This is Mayor Valensky with Driving Markets, driving while talking about markets. Remember, anything said in this piece is an opinion only. It's not financial advice, not investment advice, and just gives you a broad scope, a bit of education as what's going on in the macro picture of fundamentals, and also a little bit on the micro picture if I can get it on there in the few minutes that I have on YouTube. Very quickly, yesterday I did do a live broadcast. I had a total of 2 people join me on live. That's interesting. So obviously I'm not doing it right. I don't think the video was particularly strong, and I'm just testing out the system. So bear in mind that I'll probably continue doing some lives. They may be a bit rough, but let's see where we go from there. Remember, everything said in this particular production, this publication, is broadcast, is raw material. It is not prepared, it's not edited, it's not lighting, it's not Kardashians, it's not replay. It's just whatever happens comes out. If there's a mistake, it's a mistake by accident, but the intent is to be informative. Okay, so let's just kick off. So following on from last week, Netflix came out with massive numbers, came up well oversubscribed, and the shares shot up 8.5%. That pulled up the rest of the high-tech sector. You had Google go up, you had Microsoft go up, you had other Nasdaq stocks go up. Apple went up, CRM went up, Salesforce went up. They all went up on the back of a big boost by Netflix. The reason being is because if Netflix came out with good results, then the high-tech sector feels as though that's going to be now recession-proof, and that's going to have a big impact. Remember, Salesforce is laying off, or Microsoft laid off 10,000 workers, Salesforce is laying off workers, and Amazon's laying off 18,000 workers, and Google, parent company Alphabet, is laying off also 12,000 workers. Now, most of these workers were taken on during the pandemic, and they're probably excess. There's probably too many of them, and they're laying off the excess. You've probably got another, I reckon, about 10% or 15% of the workforce in the high-tech sector to be laid off. So there'll be more layoffs as we go along throughout 2023 and into 2024. One of the questions that are being asked is, are we going back into a bull market, and is everything okay? Well, no, we're not. What really the market's getting a boost from is a couple of good economic numbers that came out. Wage inflation, PPI, CPI was lower than expected, and that gave a little bit of a boost on the basis that the Fed won't raise interest rates too much over the next coming months. There is already a 25 basis point rise booked in, or priced in I should say, for February. Okay, now that could be impacted on this week because you've got personal consumption expenditure coming out, and that's a big one. If the number is higher than expected, then obviously it's going to put more pressure on the Fed to raise rates much faster and higher than anticipated. If it's lower than expected, which it is, by the way, then there'll be less pressure on the Fed to raise rates more than 25 basis points. Then also you've got GDP out this week, big one, GDP, gross domestic product, big measure of the overall health of the whole of the United States, where they're going. Is GDP going to be in positive territory, which shows that it's growth, there's not a recession, or is it going to go into negative territory? Now, this really is a technical number because a lot of individuals and a lot of businesses are already feeling and professing that there is a recession out there, but the official numbers, which are obviously manipulated by the governments and the statistics bureaus, are coming in as positive and not negative, but there is a real feel of recession. Also, the inflation numbers that are being produced or being published are well below what really is happening there in the food and energy sector. I mean, if you take the food and energy sector, you get price rises of easily 15-20% from month to month on food and energy. So they can't say with inflation is running at 5%, 6%. Overall, the basket of goods might be 5-6%, but individual sectors, individual pricing, like food, like energy, like housing, is very, very expensive, running more at the 15-20% level than the 5% level. Okay. We also have this week Tesla. Tesla's coming out with some numbers. Now, Tesla's interesting. The reason why it's interesting is because it's had a pretty rough time in the last quarter and maybe the last 2 quarters. The shares have dropped all the way from 230 to 100. I was calling them down all the way from 230. Remember, I called them down to 150, called them down to 130, and then I called them down to 100, went all the way down to 101, and it's bounced up from there. China's reopened, they've restructured the pricing, they expect their sales to now increase. So Tesla, even though it may have poor results this week, it could look like a buy and going back up there to 170, 180. So Tesla looks like a 170 to 180 level in the near future. Now, this particular bounce in financial markets, this push, this pumping up, will continue over the next week or 2 weeks, probably because you've got a lot of enthusiasm there, whereby they think interest rates have peaked and inflation has peaked. So that's going to add a lot of substance. I hope you can hear me, by the way. That's going to add a lot of substance to the undercurrent of pushing financial markets higher than they are. So you could see a further boost as markets move up. There's more and more enthusiasm. One example of that, of taking on risk, is the crypto sector and Bitcoin. I hope you can hear me. I don't know if you can hear me. Oh, I'll be a disaster if you can't hear me. Rearrange that. Okay, put that there. Right. So Bitcoin has, I was calling Bitcoin up already from the 19,000 level. It was hanging around the 16,500 level for nearly 2 months with the FTX scandal, and also the Gemini exchange filing for Chapter 11 bankruptcy in the US. It looks like the bankruptcies now have been dealt with. It looks like the crypto sector has absorbed the bad news and say, you know what, the bad news is out there, let's get on and move it up. And Bitcoin has moved up to above 23,000. Next immediate target short term very quickly will be 25,000. From there, a big test. I can see it going to 30,000, and then all depends on the economic climate and what is the outlook on inflation and interest rates. If there is an economic shock or something whereby the numbers don't look good and there's a pressure on inflation, then you'll see the high risk sectors like cryptos, like Bitcoin, like the Nasdaq come off significantly. I personally believe, in my opinion, that we haven't got rid of inflation. I think inflation, the undercurrent inflation, is still there, especially, as I said earlier on, in the energy sector and in the food sector, and you're going to have, in my opinion, rising inflation in 2023, not falling inflation. So that's my opinion as regards inflation. Last week, building permits in the US and building housing starts were very, very disappointing, and that sent all associated industries and sectors with the building sector down. Okay, so you had anything to do with the building sector came off last week on Thursday, as the building starts and building permits fell away. That's going to impact on the retail real estate market. That is going to continue falling in 2023, and the commercial market is going to take a hammering as more and more businesses contract and more businesses lay off staff. There'll be less need for commercial office space. So you'll see commercial office space become a lot more available, a lot more vacant, and the prices will fall significantly, and that will feed into the retail sector of the housing market. So with rising rates and housing, with mortgage rates and the layoffs, then you're going to have a big impact on real estate. It's not going to be immune, whether it's in America, the Middle East, Europe or UK. House prices will come off significantly in 2023 and in 2024, especially as mortgage holders become more distressed. Remember, as the cost of borrowing rises, it's not only mortgage holders, it's also businesses that have to end up paying a lot more money for their finance and for their loans, etc. Looking at a couple of other things, you've got a pound. Look at the foreign exchange markets. You've got the pound, which is pretty strong against the dollar. That will continue to rise up based on the fact that you've got 10.5% solid inflation in the UK, not likely to come down. Andrew Bailey will have to take some action. but the pound looks like it's going to get stronger against the US dollar and also against the euro. The euro also is picked up in some strength against the US dollar. Overall, you got a bit of weakness in US dollar because of the view that interest rates have capped, and therefore there's not really any more reason to buy the US dollar unless there's some sort of geopolitical or global crisis, but that would be more of a run to safety than economic reasons, okay? Because the dollar is seen, the greenback is seen as a safe haven when it comes to any types of crisis. The other view I have this year, which is a complete outside view, but I'm going to publish it, is that I think China is going to have a bash at invading Taiwan. The reason being is because Biden is particularly weak, and this will be the opportunity before Trump gets back in the US. Joe Biden and Kamala Harris are a pair of clowns. They don't really know how to run the state there, so it looks like China will definitely do some more flyovers and probably attack Taiwan, looking to invade Taiwan. If that was going to be the case, then obviously the price of oil would shoot up, gold and the dollar. Talking about gold, gold is above $1,900 an ounce, looking to go to $2,100 an ounce. It's on an upward trend. It's been there. We did mention it here a while ago, last month, and gold looks like it's going to test the $2,000 level very, very, very quickly. Regarding oil, oil is hanging around the $82 a barrel. Everyone thinks that oil is going to come down. With China reopening, you're going to see oil going to $95 a barrel very, very quickly, and then it'll test again the $100 a barrel level around about March time, in my opinion. But oil is got big support at the $72-73 level. Tested that, bounced up. Looks like the trend line is moving up, so oil looks like a buy at these levels, those who are traders in oil. That's more or less it. It's a pretty long session, covered most areas, I hope. If you have any questions, then you can contact me, comment on YouTube. Also, I do some TikToks that'll give you a quick snapshot of what's happening in financial markets, and also on Instagram. So you can subscribe on all of those channels if you so wish. This is Meir Walensky with Driving Markets. Have a good week.